Okay, today's lecture is on calculating returns, and this is covered a little bit in Strong's Chapter 2, but not anywhere close to the detail that I like to get into. And so I'm going to talk about a lot of things that kind of surround calculation of returns, a couple of different techniques that we can use, and so on. Really, we're switching gears. The last two chapters, chapters 3 and 4, were completely non-quantitative, and frankly not my favorite, but it is important information for you to know. Many of you know that I prefer to do math, and so this kind of thing, and from here on out in the semester there's going to be a lot more numbers involved. So today we're calculating returns. Next week we'll be talking about risk measures, which is kind of a continuation of this same topic. So let's start off by asking, what is a return? Well, a return is simply the profit on an investment, and realize that a profit could be negative. In other words, it could be a loss. So when I say profit, it could go either way. So that's all a return is it's the extra that you get back over and above what you invested. Now, we can measure returns basically in two ways. We can talk about dollar returns. So how many dollars was your profit? But that's generally not the best way to do it. A better way is to look at a percentage of the initial investment. And then often we will state that as an annualized rate of return. The advantage of using percentages is that they are comparable, whereas dollar amounts are not. So you can imagine, let's say you have two investments. One of them you invested $100, the other one you invested $1,000. Well, if the $1,000 investment returned, $300 in profit, that can't be compared to whatever the dollar return was on the $100 investment. But if we talk about it in terms of percentages, then we can compare them. The most basic measure of return is something that we call the single period holding period return, or HPR. And this is simply the percentage change in the value of the investment. Now notice when we talk about single period, a period could be any amount of time. It could be a day, a week, a month, a year, 10 years, whatever is useful for your particular purpose. And so the holding period return is calculated as simply a percentage change. So we take the ending price, that's P sub 1, plus the total cash flows that you've received, subtract off the initial price, and then divide by the initial price. So again, this is a basic percentage change calculation. Now, generally, I like to simplify this a little bit. So if we factor out P sub 0 from the numerator and denominator, then what we're left with is simply the ending price plus the cash flows divided by the beginning price minus 1. Now, it's important to note that by default, the HPR is not an annualized rate of return. However, we will often annualize returns so that they are comparable. So if you have an investment that you held for 3 months and an investment that you held for 7 months, those returns are not directly comparable. So we need to annualize them in order to be able to compare and say which was better. Let's look at an example. So imagine that you purchased 100 shares of XYZ stock for $50 per share 5 years ago. Recently, you sold the stock for $100. And in addition, while you held it, the company paid a dividend each year of $1 per share. What's the HPR? So here you see a timeline. In red at time period 0, you see the $50 outlay. And then each year you have a $1 inflow. And then at the end of year 5, you sold it for $100. So your total cash flow in year 5 is $101. So using our HPR formula, I have 100 plus the 5 dividends that you received, divided by the initial price of 50 minus 1. So that's 105 divided by 50 minus 1 gives us 1.10, which is 110%. So pretty straightforward. Now, very often, mainly for statistical reasons, instead of calculating a straight holding period return as we just did, we use what are called log price relatives. Now, before I show you how to do this, let me talk about this term price relative. So a price relative is simply the ending price divided by the beginning price. So in other words, it is the ending price relative to the beginning price. Another way to think about that is it's simply 1 plus the return. The log price relative, that means that we take the natural log of the price relatives. And that's what you see here. So the log price relative is simply the natural log, ln, of the ending price plus the cash flows divided by the beginning price. Now, there are some advantages to doing this. Number one is that it gives us a continuously compounded return. So we don't have to worry about different compounding schemes because the log price relative is a continuously compounded return. Secondly, we know, and we'll see this next week, but we know that stock prices are skewed to the right. So the distribution of stock prices is skewed to the right. And the reason for that, if you think about it for a second, the lowest stock price you can possibly have is 0. Stock prices cannot go below 0 because of limited liability, right? You can never come after a stockholder for more than they've invested in the firm. So the lowest possible stock price is 0. But there is no highest possible stock price. So the distribution of stock prices must be skewed to the right. That can cause problems statistically. Don't worry right now about what those might be. But by taking natural logs, or really any log, but generally in finance we use natural logs, that's log base E, and you remember E from calculating continuously compounded returns. So by taking logs, what that does, that has the impact of shrinking the large end of the distribution way down and having almost no effect on the small end of the distribution. And so this image that I've created here shows you the result. If you take the natural logarithm of that distribution on the left, you get something that looks much more like a normal distribution on the right. And let me show you some natural log examples so you can see what I'm talking about. So the natural log of 1,000 is 6.91. The natural log of 100, which is 10 times smaller, is 4.61. And notice that 100 is 10 times smaller than 1,000, but 4.61 is not 10 times smaller than 6.91. So that 1,000 was shrunk a lot more than the 100 by taking the log. And then one more example with 10, the natural log of 10 is 2.3. And so you see what's happened is the big numbers like 1,000 were shrunk a lot more than the small numbers like 10. And so it brings the right-hand side of that distribution in, and we end up with something much more like a symmetrical distribution. Generally speaking, this improves the statistical qualities of any calculations that we do. Also, another advantage of logs is that they convert the process of multiplication into a process of addition. So instead of adding 1 to returns and multiplying them out, we simply can add the log price relatives to get the total return. In the end, we need to take E to that final number. That's what exponentiate means. We'll see that in a second. But it's a lot easier generally to add than it is to multiply. So let's look at an example. So here we have a little table, and the stock price on day 1 was 50, on day 2 it was 52, on day 3 it was 47, and then 51, and then 54. So first of all, if you calculate from the prices the holding period return, it would be 54, the end price, divided by 50, the beginning price, minus 1, gives you 8%. And that's what you see here. Now, if we have the daily price relatives, and again, remember this, for the first one there, it's simply 52 divided by 50, that's 1.04. The next one is 47 divided by 52, which is 0.9038, and so on. So if we want to use the price relatives to calculate returns, these are not log price relatives, these are just plain price relatives. What we do is we multiply them all together and then subtract 1. And the end result of 1.04 times 0.9038, etc., minus 1 is 8%, as you can see in that formula. Now, with the log price relatives, you see those in the far right column of the table. Notice that they're different than the returns. The reason is that that return, the 4%, that's daily compounding. The 3.92 is continuous compounding, and so that's why they're different. So to combine those log price relatives and get a total return, what we do is we add them up and then we raise E to that power and subtract 1. So here's the formula. So we have e to the 0.0392 plus negative 0.1011, and you notice I have that as minus because it's a negative number, plus 0.0817 plus 0.0572. We raise e to that total and then subtract 1, and we get the same 8%. Now notice that you will have a button on your calculator that says either EXP for exponentiate or e to the x. And so that's the button that you would use to do this. So again, the main reasons for using log price relatives are the logs convert multiplication into addition, which is easier. And secondly, it improves the statistical qualities of any statistics that we might calculate, like say a beta, for example. Now, let's talk about annualizing returns. So typically, not always, but typically, returns are stated as an annualized return. And again, the reason that we do this is because it makes it easier to compare the returns on different investments. We don't have to annualize necessarily. We could compare monthly returns or semi-annual returns, but it's easier just to have a standard, and 1 year is a good standard. So the point really, though, is that any returns that you're comparing should be on an equivalent periodicity. In other words, they should all have the same, they should all be annualized, or they should be monthlyized, if that's a word, etc. Now, annualizing returns, this is just basic time value of money. So once we have a return for some period of time, could be, again, a day, a week, a month, a year, whatever it is, to annualize it, we simply take 1 plus that return, and then we raise it to the number of periods in a year. So if we have daily returns and we want to annualize them, it would be 1 plus the daily return to the 365th power, because there's 365 days in a year. And then, of course, we need to subtract 1. So let's look at an example. So in that last example that we did, we had an investment that earned an 8% return over 5 days. Now, by the way, this is not terribly realistic, but the numbers are what matter here. So we've earned 8% over 5 days. So we have a 5-day return. And then note that there are 73 5-day periods in a year. So we're going to take 1 plus our 8% return to the 73rd power, which is 365 divided by 5 minus 1. And that would give us a 274.38% per year annualized return. Now, notice the assumption here. The assumption is that every single 5 days for a year, you earn 8%. Clearly, that is unlikely to be true. And that's why, let's say that you start a new mutual fund and you've been operating for 5 days, and then you want to put out an ad because you've done well, you've earned 8%. So you put out an ad and it says, our new fund has earned 274.38% per year on an annualized basis. Well, you're going to get in trouble with the SEC because they know that it's very unlikely that you're going to repeat that performance throughout an entire year. So when it comes to reporting results for funds, what you would have to do is you would have to give a since inception return. So you would have to say, this fund has returned 8% since inception. In other words, since it was created. For returns that you've earned in a longer than a year period, you're allowed to report those as annualized, but not less than 1 year. So it's generally not a great idea to report very short-term results as annualized. Now, one other point before we look at a couple other versions of this. Note that the power is the number of periods in a year. So there are 365 divided by 5 5-day periods in a year, in other words, 73. What if instead of each of those periods being 1 day, what if they were months? So you've earned an 8% return over 5 months. Well, it's exactly the same process. So we have 1 plus the 8%, and then we raise it to how many 5-month periods are there in a year. So that's 12 months in a year divided by 5 months is, I think, 2.4, and then minus 1, and that gives us 20.29% per year. What if the 8% had been earned over a 5-year period and you wanted to annualize that? Well, how many 5-year periods are there in 1 year? Well, there's 1/5 of a 5-year period in 1 year. So our formula is 1 plus the 8% to the 1/5 power minus 1, and that would give you 1.55% per year. So I hope that's clear. Now, holding period returns can be interesting, but they do suffer from some flaws. So first of all, the HPR ignores compounding. You notice if you go back to that original example that we had 5 years where we received a $1 dividend each year. The HPR completely ignored the fact that you would likely reinvest that $1. And so by the end of the 5 years, you would have more than $1. The HPR ignores the time value of money and therefore compounding. And so it's not the best for long periods of time. It's much better to use HPRs for very short periods of time. Let's say a month or a year at the longest. But, daily or weekly or monthly is probably better. And next, as we've already talked about, the HPR by itself, unless you adjust it, is not annualized. It's for whatever time period you held the investment. And so that means that you can't necessarily compare it to other investments, at least not without annualizing it first. So the solution to this is to calculate what we call a compound average annual rate of return. And there's 2 ways basically that we do this. The first you should be familiar with, which is the IRR. Often this is referred to as a dollar-weighted or a money-weighted return. So it's money-weighted because when the cash flows happen affects the final result. So if you get a bunch of cash flows early and then you do well, you get a high IRR. If you get a bunch of cash flows early and then you do poorly, you get a low IRR. And then vice versa if those cash flows come late. So when the cash flows occur has a big impact on the result. So IRRs should only be used to evaluate a portfolio manager that has complete control over cash inflows and outflows. And that's usually not the case. So the other way that we can do this is something that I call the HPR with reinvestment. So what we're going to do is we're going to take those cash flows and we're going to reinvest them. This gives us something that's known as a time-weighted return because all that matters is the per period returns and the total amount of time. So a portfolio manager that does not control cash inflows and outflows from the portfolio should be evaluated with a time-weighted return, not a money-weighted return. Now, both of these could be called a holding period yield. So you could call it a compound average annual rate of return or a holding period yield. Generally, when you hear the word yield, it implies an annual return. Now, note that the IRR, when you just calculate it on your calculator, the IRR is going to be per period, whereas the time-weighted return generally is a total return over the whole period. So you may need to annualize these things to make them comparable. But you almost never will have the same IRR and HPR with reinvestment. They'll give you slightly different results because they differ on mainly the reinvestment assumption. So remember and we'll look at this in a minute, but the IRR assumes that you reinvest at the IRR. So if you do really well for a little while and you get an IRR of 40% per year, well, that IRR assumes that you're going to be able to reinvest at 40% per year. The HPR with reinvestment assumes that you reinvest in the portfolio and you get whatever return it earns. So there's some different assumptions there. All right, so let's look at the IRR, and you should be familiar with this. So this is our original example. You spent $50 to buy the stock or whatever it is, and then you receive cash flows of $1 each year for 5 years, and you were able to sell the investment for $100. So this is the timeline of your cash flows. So since there's no formula, because remember the problem here is that in order to calculate the IRR, you have to know the reinvestment rate. But the reinvestment rate is the same as the IRR. And so we have 2 unknowns, but only one equation. And we can't solve that. So we have to use a trial and error process, or we call it an iterative process. And your financial calculator or spreadsheet function will do this process for you. So here's the setup. What we want is for the right-hand side of this equation to equal the left-hand side. So we need to find the IRR that we can plug into the right-hand side to make the right-hand side equal 50. And again, this is a trial and error process. There are intelligent ways to go about solving it, but we don't need to worry about those here because you're just going to use your calculator. Now, in this particular example, the IRR comes out to be 16.421% per period or per year. And so if you do this equation here, you'll see that you do in fact get 50. Now, on your calculator, what you would do is you would use the IRR function, and you can see the setup here. So I put in my outflow, my $50, and then I put in all of my cash flows, and I hit enter, and I get 16.42054, etc., which rounds up to 16.421%. Now, there are problems with the IRR. Still, it's probably better than just a plain holding period return, but there are problems. As I already mentioned, it assumes that the cash flows are all reinvested at the same rate as the IRR. Not quite as obviously. Well, I guess the first one's not obvious either, but it's not obvious, but it also assumes that the cash flows occur at equally spaced intervals. So it assumes that you get a cash flow every month or every year or whatever, but the time between cash flows must be the same. Also, the IRR makes no provision for stock splits, dividends, or purchases and sales of your holdings unless you make some other adjustments. So there are issues with the IRR. So let's look at a couple of them. So this reinvestment assumption, let's see how that works. So we have an investment, and we're going to invest at 3 different reinvestment rates. So here's the table. This is our investment, the same one that we've been looking at. So you spend $50 to buy a stock, and then you get cash flows of $1 each year for 5 years, and then you sell it for $100. So if you reinvest your $1 dividends at 10% per year, then you end up with a total ending value of 106.105, which gives you an average annual return of 16.239%. Now, remember that the IRR is 16.421%. So if you reinvest at a rate that's lower than the IRR, you get a lower average per period return. What if you reinvest at 20%? So the far right column. Well, in that case, you end up with 107.442, and you get an average annual return of 16.531%. So you get more than the IRR. Only if you reinvest at the IRR, and this is the middle column there, do you end up with an average annual return of exactly the IRR, that is 16.421% per year. And hopefully you can see the problem here. If you have an investment that has a very high IRR, what are the odds that you're going to be able to reinvest the cash flows from that investment at that same very high rate of return? Pretty unlikely. So in the case of a really good investment, the IRR probably overstates your average annual return. In the case of a bad investment, it probably understates your average annual return. Now, the other assumption that I said was a problem was this idea that all of the cash flows are equally spaced in time. So a lot of times you have investments, maybe it'll pay the first cash flow 1 month from now, and the next cash flow 3 months after that, and the next one a year after that, and so on. So you can't use the IRR for those kind of cash flows unless you make some adjustments. And generally the adjustment is to find an equally spaced periodicity and put in zeros where you didn't get any cash flows. So your calculator and your spreadsheet functions won't give you the right answer unless you make those adjustments. And so let's look at an example. So here, same investment, but we're changing the timing. So there is no period 3 dividend, and there's an extra dividend at period 0.5, in other words, 6 months in to the investment. So here's the timeline in table form, and you notice the periods, we go from period 0 to period 0.5 to period 1 to period 2. There is no period 3, and then period 4 and 5. And if you just put these cash flows into your calculator and calculate the IRR, you're going to get 16.421%. But this would be wrong. So here's the adjusted cash flows. Notice what I have done is I have a period every 6 months. And I've got zeros anytime there is no cash flow, such as, let's say, period 1.5, Well, if you look in that table at the left, there is no period 1.5 cash flow, so in the table on the right, I've simply put in a 0 for that. And then if you do this in your calculator, you'll get the correct answer, which is 16.563%. So it's 7.964% per period, which annualizes because we're doing semi-annual, so that annualizes out to 16.563%. Here it is on the calculator. So you notice I've used the IRR function, but this time I have those zeros where there are no cash flows, and I get 7.964. And then to annualize that, I do 1 plus my answer divided by 100 squared minus 1, and I get 16.562% or 16.563. Now, stock splits, stock dividends, they complicate things a little bit calculating returns unless you use a database that somebody else maintains. So somebody like, let's say, FactSet or Bloomberg or Standard & Poor's or Morningstar, they maintain these databases, and anytime a company splits its stock, so I think, for example, Tesla and Apple both split, what they do is when that happens, they go and they adjust all of the historical data for that split. So if you're using one of those databases, you don't need to worry about this. But if you maintain your own database, then you have to know how to adjust for splits. Otherwise, your returns will be incorrect. You can imagine if you owned Tesla and it was over $2,000 a share just recently, and then it split, I think it was 5 for 1. So on that day that it split, it would look like you lost a lot of money if you didn't adjust for that. So the adjustment is pretty simple to do. So, imagine that XYZ split 2 for 1, that's the company that we were looking at, immediately after period 3. In this case, your dividends would be 50 cents per share instead of $1 per share in periods 4 and 5, and you would sell the stock for 50, not 100. But in fact, a stock split has no economic impact, so you didn't lose any money. If it split 2 for 1, you just have twice as many shares at half the price. So the data has to be adjusted, and normally you don't have to worry about this because you're using a database that somebody else maintains, and they'll take care of all of this. So the way that you adjust for splits is to multiply all of the historical prices, the pre-split prices, by the inverse of the split ratio. So if the split was 5 for 1, you take all of those previous prices and you divide them by 5 or multiply by 1/5. All right, now the HPR with reinvestment, this was the second way that we deal with multi-period returns. And this way, I believe, is better generally than the IRR. But again, this is a time-weighted return, and so it's not always appropriate. If you're managing your own portfolio and you want to, so you control all of the cash inflows and outflows, and you want to know how you did, the IRR or a money-weighted return is a better way to go. But in general, we're going to be evaluating portfolio managers that do not have control over the cash flows. And so the HPR with reinvestment or a time-weighted return is a better way to go. Now, you might also see this referred to as a total return index, especially for charts that show performance over time. So this is kind of a $1 grows to kind of a calculation. So all we're doing here is we're going to geometrically link a series of sub-period HPRs. So for example, we might take daily holding period returns, or more likely, we would have holding period returns for every period where there is a cash flow. And then we geometrically link them. And that's just a fancy way of saying we multiply. So the shorter the time period, the more accurate the result will be. And this improves on the IRR because it doesn't assume that the cash flows are reinvested at the IRR. Instead, it assumes that they're reinvested right back into the same investment. Now, the downside of this is that we need to know the price of the asset every time there's a cash flow. So if money comes into the portfolio or goes out of the portfolio, we need to know the value of the portfolio on that date. Or if a stock pays a dividend, we need to know the price of the stock on that date. And we need that for the entire history that we're calculating the return for. So we need a little bit more data than we would with an IRR calculation. Now, the other benefit is that because we're geometrically linking these HPRs, it doesn't matter that if the time period in between cash flows is the same or not, because we're multiplying. So it simply has no effect. So let's look at an example. So this is our same exact timeline that we had before, except now I've added stock prices. Be aware that if you add different stock prices, you're going to have different holding period returns for each year. But that's okay. So I just made up some stock prices. So the stock went from 50 to 58 to 52 to 75 to 90 to 100. And then you can see the cash flows in each period. So notice that at the end of period 1, you didn't really sell the stock for 58. You could have, but you didn't sell it. You held on and collected the dividends for the remaining periods. So what we're going to do is we're going to use the stock prices and the cash flows to calculate the HPR for each period. And then we're going to link those together. So our holding period return with reinvestment is the product of 1 plus each sub-period HPR, and then you take that final result and subtract 1. So that pi that you see there, it's just like a summation sign, except it means multiply instead of add. So we're multiplying 1 plus each sub-period HPR. So here are our sub-period HPR. So for period 1, we had 58 plus a $1 cash flow gives us 59, divided by 50 gives us, and minus 1 gives us 18%. So here's the formula. For period 2, same idea, except our starting price now is 58 instead of 50. So we have 52 plus 1 divided by 58, minus 1 gives us negative 8.62%. And then for period 3, period 4, and period 5. So you can see how I got those numbers in the far right column of that table. At this point, we need to link these together. So we're going to add 1 to each of these sub-period returns, multiply them out, and then subtract 1. So we have 1.18 times 0.9138. Now, by the way, be careful with negative returns. A lot of times people will make the mistake of saying, well, 1 plus and then 8.62 is 1.0862, but it's not, because that's a negative 8.62%. And so when you do the math here, you get 114.58% for your total return. Now, remember, the IRR was, I think, 16.42%. Remember, that's per year. This is a total for the 5 years, or I guess the table says days, but I think I said it was years. So this is 114.58% over that entire time frame, whereas the IRR was per year. So you would need to take that HPR with reinvestment and annualize it in order to compare it to the IRR. And if you did that, it would simply be 2.11458 to the 1/5 power minus 1, and you would get 16.5%. So a little bit higher than the IRR. Now, I don't have that on the slide. I just did it on my calculator. So the annualized HPR with reinvestment was about 16.5%. What happens if money goes into or comes out of a portfolio? So this is a little bit more complicated issue. So imagine you manage a portfolio for a client, and the client calls you up and says, hey, I need to take out $10,000. All right. So you send them a check for you sell some securities, you send them a check for $10,000. But now you're managing less money. And so it would seem that that has an effect on the return. But remember, this withdrawal is not the fault of the portfolio manager. And so the portfolio manager should not be penalized if the timing is bad on that, or rewarded if the timing on that withdrawal is really good. So we need to somehow factor out those additions and withdrawals. So the way that we're going to do this is we're going to create what you might call a portfolio index. And this is automatically going to handle splits and dividends because they don't affect the total value of the portfolio. So remember, when a company pays a dividend, the stock price will go down by the amount of the dividend per share. So the total value of the stock should be unchanged unless there's something else going on, right? So the dividend itself has no impact on the value but there may be other things at the same time that do affect the value. So this technique that we're going to talk about is called the unit value method, or sometimes called the NAV method. And here you can see where it was first introduced. So what we're going to do is we're going to create a value per unit, or it's usually called a net asset value, or NAV, per share. And this notion of shares is just whatever you want it to be. So you pick a number, right? So I like to say, well, let's assume that we own 100 shares in the portfolio. But you could pick 50 or 1,000 or 212.5 shares if you want. It's just better to start with an easy number. And then what we're going to do is every time there's a cash flow in or out of the portfolio, we're going to calculate the return. So here's an example. So you're creating a portfolio. You have $5,000 to begin with, and you invested in 3 stocks, ABC, XYZ, and XXX. The following table shows the current prices and the number of shares, and we're ignoring commissions here. So ABC is at 20, XYZ is at 40, and XXX is at 50, and you buy 75 shares of ABC, 37 of XYZ, and 40 of XXX. You can see your total investment in each one, and then you only invested $4,980, so you had $20 in cash left over. So that adds up to $5,000 for the total value of the portfolio. Let's say that a month goes by, and now your portfolio is going to look like this. So you can see on the left the original portfolio, and on the right what it is today. And the only thing that has changed is that the prices of the securities have changed a little bit. So ABC went up to 22, XYZ went up to 41, and XXX went down to 47. So net, your portfolio now is worth $5,067. So your return for that 1 month is 1.34%. So here's how we calculate that. You ended up the month with $5,067. You started with $5,000, and then we subtract 1, and you get 1.34%. Now, if we were to annualize that, it would come to 17.32%. And so the way that we get that, again, is we just add 1 to that monthly return. And since there are 12 months in a year, we raise that to the 12th power and subtract 1, and we get 17.23%. Okay, so now a month has gone by, and you're doing pretty well, so you decide that you're going to put another $1,000 into the portfolio. Now notice, nothing else has changed. No time has gone by. So you had $5,067, you put another $1,000 in, and now you have $6,067. So your portfolio looks like this. Notice that this is the same table that we had before, except cash has gone up from 20 to 1,020. So if you calculate your return now, you take 6,067 divided by the 5,000 you started with. That looks incredible. You've got a return of 21.34% in a month. That would be 919% if you annualized it. Wow. But of course, that's not true, because that $1,000 you just put in is not a return on the investment. It's a new investment. And so you can't count it as a return on your portfolio. This is the kind of thing that we want to avoid by using the unit value method. So there's the plain calculation if you didn't know any better. And here's the annualized calculation. So it looks incredible, but you've made a serious mistake. And as I said, obviously this is not correct, because the $1,000 you just put in is not an investment gain. So you shouldn't count it. There was a very famous example, I think back in the 1990s, of the Beardstown Ladies. This was an investment club made up of a bunch of little old ladies, honestly, and they thought their portfolio was doing so great. They were dramatically outperforming the S&P 500 every year. And so they decided to write a book. And they wrote a book on their investment methodology. And it was, I don't know if it was a bestseller, but it sold very well. It was an interesting book. It had recipes and all of that kind of stuff that you might expect. But it all turned out to be incorrect. Because what happens with an investment club is that the members generally add new money in at each monthly meeting. The Beardstown Ladies were counting that new money as investment returns. So you can't do that. Let's go back to this idea of creating an index for your portfolio. So we're going to arbitrarily set the starting number of shares Let's make it 100. So for your portfolio, you started with $5,000. So each share would be worth $50 at the beginning. This is your net asset value, and you can see how we calculate that. It's simply the total value of the portfolio divided by the number of shares. So 5,000 divided by 100 is $50 per share. That's at the very beginning. Now, after 1 month went by, the portfolio rose to a value of 5,067. We said you have 100 shares, so each one must be worth 50.67. Again, that's your net asset value, and here you can see the calculation. Very simple. Now, we can use the NAV to calculate the rate of return. And in fact, we want to do that instead of using the total value of the portfolio. This is how we're going to avoid calculating inflows and outflows as part of the return. So if you take your ending NAV after 1 month, 50.67, divided by your beginning NAV, minus 1, you get 1.34%. That's the same number that we got earlier. Now, though, you've added this $1,000, which originally distorted our calculation. So how do we deal with this? Well, what we're going to do is we're going to use that $1,000 to buy more shares in the portfolio. So the new shares that we can buy, the number of new shares, is simply the new cash, that's the 1,000, divided by the net asset value per share, which is 50.67. So 1,000 divided by 50.67 gives us 19.74 additional shares. So now you're going to have your original 100 shares plus 19.74 additional shares. And so if you take the 6,067 divided by 119.74, you get the same net asset value per share, 50.67. So adding money did not change our NAV. It did change the total value of the portfolio, but it did not affect the NAV. And so our return calculations, if we use the net asset values to calculate the returns, will be unaffected. Now, it's important to note that if you took money out, let's say you took out 1,000, then in the numerator there you'd have negative 1,000, and you would end up selling shares, so you'd end up with fewer shares than you had originally. But other than that, it doesn't change anything. So a month goes by, again, and the prices of the stocks have changed, but you still have the same amount of cash, but now your portfolio is worth $5,943. So your NAV is 5,943 divided by 119.74 shares, or 49.63 per share. So your return in that 1 month is negative 2.05%. All right, so 2 months have gone by, and your $5,000 portfolio has grown to 5,943. It looks like you've got a 2-month return of 18.86%. But remember, you put in an additional $1,000. So your actual return is negative 0.74%. And we can see this by taking our current net asset value divided by the beginning net asset value minus 1, and that gives us negative 0.74%. So if we do this correctly and we use the NAVs, then inflows and outflows do not affect return on the portfolio. So anytime money goes into or is taken out of a portfolio, we change the number of shares by buying or selling them at whatever the net asset value is at that point in time. So dividends don't affect this calculation because, as I said earlier, dividends leave the total value of the portfolio unchanged. So when there's dividends, we don't have to buy or sell shares. The dividend just goes into cash. So it comes out of the value of the stock, but it goes into cash, and the net result is no change. Similarly, stock splits have no economic impact. They're not going to affect the total value of that stock holding. And so they have no impact on the value of the portfolio, so we don't need to do anything with them. Okay, now another issue that we need to deal with is this idea of arithmetic and geometric means, or arithmetic versus geometric returns. Now, a lot of times when people need to calculate an average rate of return over some amount of time, they tend to use an arithmetic average. However, that is incorrect. And the reason it's incorrect is because the arithmetic average ignores compounding. So let's look at a simple example here. Suppose that you purchased shares in CDE 2 years ago. During the first year, the stock doubled, but then it fell by 50% in the second year. What is your average annual rate of return? So think about this for just a second. Let's say you buy a stock for $25 per share, and then it doubles. So now it's worth $50. If it loses half, it's back to $25. So your average annual return should be 0. Here's a timeline that shows those returns. Now, the arithmetic mean is simply the sum of all the per period returns divided by the number of returns that you have. In this case, divided by 2. And so we have 100% plus negative 50% divided by 2 gives us 25% per year. Now think about that. That doesn't make any sense. We know that by the end of the 2 years, you were exactly back to where you started. So your total return is 0. Therefore, your average annual return should be 0 as well. Now, the geometric mean does not have this problem. So the geometric mean is simply the product of 1 plus each sub-period return, and then you take the nth root of the result and subtract 1. In this case, we have 1 plus 100% times 1 plus negative 50%. We take the square root of that, subtract 1, and we get a 0% average annual rate of return. So what's the difference? Well, the difference is, and this is obviously an extreme example, but the difference is that the arithmetic mean tells you what your typical annual return was, and the geometric mean tells you what your compound average annual return was. So since you started out and ended up in the same place, your compound average annual return must be 0. But you could make an argument that typical return was 25% per year, although it's really pretty misleading to say that. So the point here is anytime you're dealing with returns over time, you almost certainly should be using compound average annual returns, geometric means. There are exceptions to that, but generally that's the case. Another issue, and this is the last issue that we'll talk about, has to do with calculating rates of return on foreign investments. So the basic idea is the same, but the problem is that we really have two investments. You're investing in some foreign security, but you're also at the same time investing in that foreign currency. So we have two sources of return. We have the return on the investment itself, and then we have the return on the currency. So let's look at an example. So there's a big iron company named Pohang Iron and Steel that trades on the Korean Stock Exchange. It's a South Korean company. And on January 3rd, 1997, let's say that you bought the stock and then you sold the stock on December 27th, 1997. Now the kicker is that in the middle of 1997, there was a really serious Asian currency crisis. So Asian currencies pretty much across the board lost about half of their value, and the Korean won was no exception. So here's the situation. On January 3rd, you bought the stock for 37,300 won. Now keep in mind that you would have to convert your dollars into won before doing this transaction. So that's where the currency play comes into effect. And then on December 27th, you sold the stock for 45,900 won. That looks pretty good. And in fact, if you were a Korean investor, you would have earned 23.06% on that investment. The problem, of course, is that you're an American investor who makes their money and invests their money typically in dollars, not Korean won. And so we need to account for the exchange rate fluctuations. And you can see at the beginning of the year, the exchange rate was 842.6 won per dollar. And at the end of the year, it was 1,500 won per dollar. So the Korean won lost about half of its value. Now, what we need to do then is convert these prices from won into dollars. And to do that, you take that beginning price divided by 842.6, and you find that you paid the equivalent of $44.27 per share. And for the ending price, you have $45,900 divided by 1,500, or $30.60 per share. So clearly, in dollar terms, you lost money on this investment. More specifically, we can see that you lost 30.88%. So you can see how the currency component of the return can be, in some circumstances, a very big part of your overall return. Now, this was a huge event, this Asian currency crisis in 1997. And that's why I still use this example, even though it's very old, because it's one of the more extreme examples that I can come up with. The lesson is always convert prices into your home currency before calculating the return. Now, we can do this with one equation, and that equation looks like this. Dollar cost is the price you paid in the foreign currency times 1 over the foreign exchange rate, and this is measured in foreign currency per dollar. And in this case, that tells us our cost was $44.27. The proceeds are calculated the same way, except obviously the price and the exchange rate will be different. So the proceeds from the sale at the end of the year, we take our ending price times 1 over the exchange rate, and that gives us 30.6. And we can combine these equations and substitute them into our HPR equation, and what we end up with looks like this. You take the ending price times the beginning exchange rate, divided by the beginning price times the ending exchange rate, and subtract 1. And you can see how that works out. And in dollar terms, then, we get a return of negative 30.88%. So in this case, you made money on the stock itself, you lost money on the currency, and overall, you lost a lot of money. Here's another example from a couple of years later. So in this case, you're purchasing Diageo PLC, and you bought it on the London Stock Exchange for 630 pence per share. Or I'm sorry, you sold it for 630 pence per share. And 1 year earlier, you could have bought it for 542 pence per share. So a British investor would have made a return of 16.24%. However, an American investor in this case would have made 17.78% because the British pound increased against the dollar. And here's our little formula, and it shows that the American would have made 17.78%. All right, so that's my lecture on calculating returns. I hope that you found this useful. I know that sometimes there's a lot going on and it can be a little bit confusing how to do the calculations. So please make sure that you practice and confirm all of the numbers that I've given you in this slideshow. So remember, the PowerPoint slides are available for you to download on Canvas so that you can go through this at your leisure. All right, I'll see you next week with a lecture on risk measures.